Okay, when it comes to the cost of capital, we in our example, in most small businesses, we're going to use a single example of a loan and shareholders. It's pretty easy to compute the cost of a loan. The bank tells you when you sign the loan agreement or the mortgage how much it's going to be, or if you have a fluctuating interest rate, you pick it off from your monthly statement. So pretty easy to figure that out. Currently, mortgages and commercial loans and that sort of thing are anywhere from 7 to 10%. For our example today, going to assume 7%. This is assuming that you, the business owner, and the company have a good credit score. Okay, because if you've got a personal bad credit score, the interest rate's going to go up. Okay, or if the company's got a bad credit score, the interest rates go up. If you get the loan, sometimes you might not even get the loan if you both got a bad credit score. They do this because when you sign as a president or whatever it is of the company for the loan, there's a part on the loan agreement or the mortgage agreement that says if you don't, or if the company doesn't pay the bill, you will pay the bill. So that's why they look at those two things. Credit scores of both of you, and they say, okay, well, first of all, are you going to get the loan or not? Or if you do, you'll get a better rate if your credit scores are good. Okay, shareholders are a little bit different than the banks, and they take into consideration a number of things, except maybe for mom and dad who might just give you the money as a loan and not worry too much about it without return, that sort of thing. Your sophisticated or average angel investor or somebody who's concerned about getting return, you're going to think of a couple of things. Inflation, okay? And the best example in my life of inflation when I was young, a loaf of bread was 23 cents. Okay, pretty cool. So if my mother sent me down to the store to get some bread, she'd give me a quarter, and away I go, get a loaf of bread. Now imagine how upset I was one day when the loaf of bread went up to 24 cents. Why was I upset? Because with the 2 cents, I was allowed to buy candy. That was my reward for going down to the store. So all of a sudden, my candy allowance is cut in half, or reward is cut in half. That's inflation. Okay? Your dollar doesn't buy as much as it used to. In this case, so if we talk about bread, now I'm looking at $2 or $3 for a loaf of bread. So that's what the inflation does. It actually takes your dollar and makes it worth less money every year. So really, if you're going to invest a dollar, you should really have more than 2.5% a year return on it. Okay. When we look at GICs and that sort of thing, there's another thing to consider. Return on 2-year GICs right now is actually less than 1%. When I originally did this slide, it was a little higher. And I can invest my $100 and get 1.1%, which is less than the rate of inflation right now, by the way. So it kind of asks the question, well, why would I do that? Well, if you're just trying to conserve your capital or sort of preserve it, I guess is a better word, without any risk, i.e. you'll always get it back. You can use a GIC as an investment tool, but just be aware you're still really losing money, and I hate to tell you that's the way the financial system works in the planet. Okay. And then you could do like I'm doing. I buy my shares in Suncor that owns Petrocan, and they have two things going on. Even though the price of oil is tanked out or bottomed out in the last while, before that happened, the return on my investment, i.e. how much more they were worth, was 40%. Now it's only 10%, so you could say I've lost 30%. But on my original investment, I've gained 10%. Plus, each year I get 3 or 4% of my original investment in dividends. Okay, so my return on my investment, if I was to take it at, say, a year, would be about 12, 13, 14%, depending on when I sold my shares, if I really wanted to sell my shares. So that's something else. If I was going to invest in a company, or your company, for instance, I would look at such things as opportunity cost. I could invest my money somewhere else and make money. Okay, that's the opportunity I have. If I'm investing with your company, I have to give up that opportunity. So we got these three things rolled into the whole decision, and that's just basic sort of return. If I'm going to invest with your company, I've got to be fairly cognizant that there's more risk. We'll talk about risk in a second, but I at least want a good return on what I'm doing. Okay, just the way it is. Okay, now when we talk about the shareholders' investments, the original investment they put in, share capital, when we start a corporation, we buy shares in the company, plus any retained earnings. So what we're talking about is the owner's equity in the company. That is the owner's or the shareholders' investment. And we'd have, when we look at the balance sheet, we have a balance on that. We have the dollars that they have tied up in the company. The owner will look at all the things that we've mentioned, risk, inflation, risk-free rate, opportunity costs, all those fun things, and say, okay, I kind of have an idea of what I want for a return. Now, I'm going to give a little jolt here, and I see this fairly frequently in some small business situations. If I'm going to invest my money, run my company, and if I don't get a return on my investment, at least equal, for instance, for me, my Suncor shares, plus my wages. Why do it? Notice I say plus my wages. Yes, you can buy yourself a job, but if you can work at Max Milk and make $30,000 a year, why buy a company, have all the hassle, make $30,000 a year, and not get a return on your investment? The job is not the return on the investment. Okay, if you can work anywhere and get the same amount of money, that's not the return on the investment. So we got to distinguish about this. Okay. Now, if I can pay myself a bonus out of the profits at the end of the year, yes, that's something different. If I can get dividends, and of course your accountant would set up all these things, because the idea, of course, is to make money and not give it all to the government. These are the sort of things a business owner has to think about. If I can work at Max Milk and get $30,000 a year and have $50,000 in a bank account someplace or invested with a publicly traded company and get 5, 6, 7% return a year, then really, if I'm going to invest in my company, I better get $30,000 plus 5 or 6% return on my $50,000 I'm going to invest. At least 5 or 6%. Otherwise, why do it? Yes, we're going to buy satisfaction. Yes, we're going to be in control. But realize that starting out, most small business owners pay themselves less than minimum wage. Okay, less than minimum. That's just government statistics. That's reality. That's the way it is. So you have to think about that sort of thing. Otherwise, why do it?